The Wealth Architect. Episode 1. The inciting incident. Every great story has a beginning. A moment of truth. For most of us, that moment is realizing the script we've been handed is broken. We're all trapped in a narrative we didn't write. The endless cycle of check to the whispers of not enough. This isn't just about money. It's about control. And right now, they have the pen. Before we talk about stocks, bonds, or real estate, we need to talk about the most powerful financial asset you own, your mind. The scarcity mindset is the villain of our story. It makes you ask, how can I afford this? Or what if I lose it all? It keeps you small, constantly reacting to fear. The shift. It's the inciting incident. The moment you stop asking, how can I afford it? And start asking, how can I create it? This is the moment a millionaire is born. Long before the first dollar is earned. Think of Elon Musk, sitting in a small office, dreaming of Mars. Was he asking, can I afford a rocket? No. He was asking, how do I make humanity an interplanetary species? His vision preceded his valuation. That's the mindset shift. In this episode, we need to define your financial North Star. Where are you going? Without a target, every dollar is just wasted ammunition. Here is the formula, your first action step. Write this down. 1. The freedom figure, the stop work number. What is the exact, specific number you need invested to cover your desired annual living expenses forever? This is your destination. 2. The purpose metric, the why factor. What will that freedom allow you to do? Travel. Start a nonprofit. Money is a tool, not a trophy. Define the purpose of the wealth. 3. The leverage point, the how strategy. Based on your current skills, what is the fastest, most effective way to multiply your income? This is your vehicle. Take Warren Buffett. His freedom figure was simple. Total self-sufficiency. His purpose metric, the joy of the game. His leverage point, value investing. He defined the destination, then built the vehicle. You've just completed the first act of your financial film. You've had your inciting incident and you've charted your North Star. The difference between those who succeed and those who just dream is one thing. Action. Today, your action is to answer those 3 questions with brutal honesty. The Wealth Architect. Episode 2. The blueprint last time, you had your inciting incident. You defined your financial North Star, that big, scary, beautiful number. But a vision without a plan is just a hallucination. Think of it like a skyscraper. You don't just wish it into existence. You need a blueprint. Your current financial structure is likely built on sand, crumbling with every impulse buy. We're tearing it down. Most people's budgets are a tangled, reactive mess. They track what they spend, but they never dictate what they will spend. That's the difference between a journalist and an architect. We are the architects. Forget spreadsheets that shame you. We use the 50-30-20 rule, but with a crucial twist. We assign a purpose to every dollar before it lands in your bank account. 50% needs the fortress foundation. Rent, groceries, minimum debt payments, the non-negotiables. If you need to exceed 50% of your take-home pay, you have a spending problem or an earning problem. 30% wants the joy fund, restaurants, travel, that nice new gadget. This is your fixed budget for enjoyment. When the money's gone, the spending stops. No emotional spillover. 20%. Investimento. The freedom fuel. This is the most important number. Savings, investing, extra debt payments. This 20% is non-negotiable. It's your future self's paycheck. Now, the core action that separates the rich from the rest, it's called the first law of wealth. Pay yourself first. And we execute this with one word. Automation. The moment your paycheck hits your bank, that 20% must automatically transfer to a separate investment or savings account before you see it, before you feel it. It becomes invisible money, locked away in your freedom fortress. If you wait until the end of the month to see what's left, I promise you, nothing will be left. Think of Oprah Winfrey. Her empire wasn't built on saving what was left over. She treated her future growth like a mandatory bill, due on the first of the month. The system was designed to protect her wealth from herself. This isn't discipline. It's superior system design. Your current self is a threat to your future self. We neutralize that threat with automation. Your action for this episode is clear. Implement the automation trigger. Set up that transfer today. Lock away that 20%. If that 20% feels impossible to achieve right now, you have one mission for episode 3. The leveraged play. We're not cutting back on lattes anymore. We're going to learn how to massively increase your earning potential and change the numerator of the equation. In our last episode, you mastered the leveraged play, turning your skills into a powerful income stream. Now, money is flowing in faster than ever. But here's the hard truth. Just earning more won't make you wealthy. It just upgrades your lifestyle. True wealth isn't about working harder. It's about making your money work for you. Today, we build your investment engine. What truly separates the rich from everyone else? It's the gap between their income and their assets. Most people trade their time for money and then use that money to buy liabilities, things that constantly drain their wallets. The wealthy, however, trade their skills for money and immediately use it to buy assets, things that put money back into their pockets. The key to this entire process is what Einstein called the eighth wonder of the world: compound interest. Think of it as your silent, tireless business partner. It's the most powerful financial force in the universe, but it requires 2 things from you: time and consistency. Let me show you what I mean. Imagine a 25-year-old who starts investing just $500 a month. Now, picture a 35-year-old who starts investing double that, $1,000 a month. By the time they both reach 65, the 25-year-old will have significantly more wealth. Why? Because those first 10 years are when compounding does its heaviest lifting. Your money starts earning money, and then that money starts earning even more money. Your job isn't to be a Wall Street genius hunting for the next hot stock. Your job is to simply be present in the market, consistently, month after month. For the wealth architect, this investment engine must be simple, scalable, and automated. Forget the complex strategies and day trading stress. We're focusing on 3 core pillars for true hands-off growth. Pillar number 1 is the Global Index Fund. This is the foundation of your wealth. It's the boring but brilliant secret of countless millionaires. Instead of gambling on individual companies, you buy a tiny slice of all the winners at once. An index fund that tracks the S&P 500 on the entire global market gives you instant diversification and eliminates the need for endless research. Your action step here is simple. Automate that 20% freedom fuel we talked about in episode 2 directly into a diversified index fund. This is the bedrock of your financial fortress. Next, we have pillar 2. Income-producing real estate. This is your cash flow engine. Real estate is the ultimate leverage play. You use a small down payment to control a large, appreciating asset. Better yet, it generates consistent cash flow through rent and offers incredible tax advantages. Now, you don't have to be a landlord fixing toilets at 2 a.m. You can explore real estate investment trusts or REITs, which trade like stocks and give you hands-off access to a portfolio of properties. Finally, pillar 3 is the scalable business asset. This is your wealth multiplier. Remember that side hustle we developed in episode 3? We're now turning it into a passive income machine. Whether it's an online course, a subscription service, or a small business that runs without your daily input, this asset gives you ultimate control and the highest potential for exponential growth. Why? Because you own 100% of the profits. Look at Jeff Bezos. He didn't just focus on earning a high salary. He built an asset Amazon that was designed to compound and grow exponentially. For years, he reinvested every penny back into expanding the asset's reach. Your mindset should be exactly the same. Take the profits from your work and your assets and plow them right back into these 3 pillars to accelerate the compounding effect. So here is your homework for this week. It's time to take action. Choose your first pillar, one investment specific, low-cost index, fund and set up an automatic monthly transfer. This isn't just another transaction. This is the exact moment your money officially starts working harder for you than you do for it. Take this step, and you're well on your way to becoming a true wealth architect. Thank you for watching. If you're finding this series valuable, please hit that like button, subscribe, and turn on notifications so you do. And miss the next episode where we put all of these pieces together. In the last episode, you've mastered the leveraged play, turning high-value skills into multiplied income. Congratulations! You've increased the velocity of money coming in, but simply earning more doesn't make you wealthy. It just gives you a higher maintenance lifestyle. The goal is to stop being the one who does all the work and start having your money do the work for you. This is where we build the investment engine. The difference between rich and poor is the distance between their income and their assets. The poor trade time for money and buy liabilities, things that cost them money. The wealthy trade skills for money and buy assets, things that make them money. The law of compounding, the eighth wonder. You must treat compound interest like a silent business partner. It's the most powerful financial force, but it demands one thing: time and consistency. Let's look at the math. A Vinci 5-year-old consistently investing $500 a month will have significantly more wealth at 65 than a 35-year-old investing $1,000 a month.
Why?
The early years are when your money earns the most money. Your job is not to find the next hot stock. Your job is to be predictably present in the market. The 3 pillars of passive investing for the wealth architect: the investment engine must be simple, scalable, and automated. We focus on 3 core asset classes for true passive growth. Pillar 1, the global index fund, the foundation. This is the boring, brilliant secret of millionaires. Instead of trying to pick the winners, you buy a tiny slice of all the winners. An index fund like one, tracking the S&P 500, or the global market gives you instant diversification and eliminates the need for constant research. Your action. Automate your freedom, fuel that 20% from episode to directly into a low diversified index ETF. This is the bedrock of your fortress. Pillar 2, the income-producing real estate, the cash flow engine. Real estate is the ultimate leverage play. You use a small amount of cash, a down payment, to control a large, appreciating asset. Furthermore, it generates cash flow rent and offers significant tax advantages, depreciation. You don't need to be a landlord. Explore real estate investment trusts, REITs for liquid, hands-off access, or syndicated deals for larger passive investments. Pillar 3, the scalable business asset, the wealth multiplier. This is your personal side hustle from episode 3, now generating income passively. Whether it's an online course, a subscription service, or a small company running without your daily input, this asset gives you control and the highest potential for exponential growth because you own 100% of the profits. The millionaire example. Jeff Bezos. Bezos didn't just earn more. He bought an asset that compounded. Amazon wasn't initially profitable, but it was a leveraged asset designed to grow exponentially. He took capital and plowed it back into expanding the asset's reach. Your focus should be the same, reinvesting your profits back into these 3 pillars to accelerate compounding. Your homework is to choose your first Pillar 1 investment vehicle, the specific index fund, and set up the automatic monthly transfer. This is the moment your money officially starts working harder than you do. You've established the vision, built the blueprint, initiated the leverage, and fired up the investment engine. You've done the heavy lifting. Now, we confront the final boss: consistency. Success isn't about one great day or one brilliant trade. It's about the monotonous, often boring, daily rituals that compound into extraordinary results. The wealthy don't have magical secrets. They just have better habits. This is how you guarantee you don't just reach your North Star, but you stay there. Ritual 1. The clarity hour, the morning attack. The average person checks their email and social media first thing, immediately surrendering the day to someone else's agenda. The wealth architect claims the first 60 minutes of their day for deliberate, focused work. This hour is reserved for learning, reading a value book, industry reports, or financial news. Sharpening the axe. Creation. Working on your leveraged asset. That's side hustler skilled from episode 3. Before distractions hit. Planning. Reviewing your top 3 non-negotiable tasks for the day that move you closer to your financial goals. Example. Benjamin Franklin famously started his day asking, "What good shall I do this day?" He was a time billionaire because he was a priority architect. Protect this hour with a moat and a drawbridge. It is your most sacred asset. Ritual 2. The money minute, the daily check-in. You automated your investment, which is great, but detachment leads to drift. Every day, or at least every other day, spend 1 minute checking your financial dashboard. This isn't about emotional trading or panic selling. It's about awareness and recalibration. Check your total net worth figure. Is it trending up? Review your spending against your 50/30/20 blueprint. Did you breach the once budget? Confirm your automated transfers went through. This ritual creates a constant, low-level feedback loop. It stops small errors from becoming catastrophic problems. You are the CEO of your wealth, and the Money Minute is your daily board meeting. Ritual 3. The de-escalation protocol, the evening review. Most people end their day exhausted, scrolling through junk. The wealthy use the evening to process and prepare for exponential growth. Before you sleep, practice the de-escalation protocol. Gratitude. Write down 3 things you are genuinely grateful for. This shifts your brain from a scarcity mindset, what I lack, to an abundance mindset, what I have. Wealth creation is an emotional game. The done list. Note the 3 things you accomplished today, ideally your targets from the clarity hour. This builds momentum and self-prep for tomorrow. Lay out the first task for your clarity hour. Decision fatigue is real. Eliminate it by making tomorrow's first move today. Example. Tony Robbins uses intense, structured morning routines to prime his mental and physical state. Success isn't about being motivated. It's about being primed. These rituals are your priming mechanisms. Your final action step for this series is to implement the clarity hour tomorrow morning. Set the alarm. Put the phone away. Dedicate that first hour to your future self. You now have the full playbook, the mindset, the plan, the income strategies, the investment vehicles, and the daily habits. The story is no longer being written for you. You hold the pen. You've built the skyscraper! You've implemented the daily rituals. You are consistently creating, investing, and growing. The narrative shifts now. It's no longer about accumulation. It's about preservation and purpose. Welcome to the long game, Phase 1. Risk management, building the moat. If you're not managing risk, you're not investing, you're gambling. The wealthy don't just focus on maximizing returns. They obsess over minimizing catastrophic loss. This requires 2 key defenses. 1. The financial firewall emergency fund. You must have 6 to 12 months of living expenses secured in a high-yield savings account or short-term liquid asset. This is your insurance against job loss, market volatility, or unexpected crises. This fund is not for investment. It is for peace of mind. Never touch it. 2. Portfolio rebalancing, the discipline of pruning. Your investment engine from episode 4 is running, but it will become unbalanced. If stocks have had a great year, they might now represent 80% of your portfolio, making you highly exposed. The ritual. Once or twice a year. Sell some of the assets that have grown too large and reinvested proceeds into the assets that have lagged. This forces you to buy low and sell high, the fundamental discipline that most investors forget. Phase 2. Legacy creation, the purpose of the profit. Once your freedom figure, your North Star is secure. Money shifts from a tool for personal survival to a tool for impact. The wealthiest people view their capital not just as savings, but as a resource allocated to creating a better world. This is the point where you define your legacy metric. The giving budget. Just like you automated your 20% investment, automate a percentage for giving charity or impact investing. This is not an afterthought. It's a planned allocation that reinforces your abundance mindset. You are wealthy enough to contribute to the solutions, not just consume the results. The example of Warren Buffett. Buffett famously dedicated the vast majority of his wealth to philanthropy. He realized the purpose of accumulating capital was not the number itself, but the scale of good that number could achieve. He used the profits of his investing genius to fund global health initiatives. Your scale may be different, but the principle is the same. Wealth requires responsibility. Phase 3. The next generation architect, the final act of the long game, is ensuring the wealth you have created continues to grow and benefit future generations, not just financially, but mentally. Educate. Don't enable. Teach the principles of the 50-30-20 blueprint. Automation and leveraged income to your children or men. True legacy is passing on the mindset and the system, not just the cash. Financial education is the ultimate gift of wealth. You now possess the complete architecture for financial freedom. You have the inciting incident, the blueprint, the leverage, the engine, the rituals, and the moat. The story of the wealth architect is ongoing. Your mission now is simple. Stay the course. Stick to the system. Never stop learning. And use the freedom you've created to build a life of profound meaning and impact. You've mastered the mechanics, the budgeting, the investing, the leverage, But financial freedom isn't just a game of numbers. It's a game of psychology. Why do people who win the lottery often end up broke? Why do highly paid professionals live paycheck to paycheck? The answer is simple. They won the outer game, but they failed the inner game. This special episode is dedicated to optimizing your most important asset, your financial operating system. The two psychological traps. There are two dominant emotional forces that sabotage wealth creation, regardless of income. 1. The lifestyle creep trap. This is the silent killer. As your income from the leveraged play increases, your expenses immediately expand to fill the void. A raise means a bigger apartment. A bonus means a fancier car. You've simply bought a more expensive hamster wheel, the fix. The future self-tax. For every raise or unexpected income, boost like a bonus. Automatically allocate 75% of the net increase directly to your investment engine before you even feel the money in your account. Treat the 25% remainder as a small Cerebro Knot tactical splurge. This ritual keeps your core expenses low while accelerating your wealth trajectory. 2. The comparison trap. The Joneses. This is fueled by social media and instant gratification. You feel pressured to buy things you don't need, with money you don't have, to impress people you don't even like. Your wealth is measured by your net worth, not your jewelry or car loan. The fix. Define your own success. Return to your purpose metric from episode 1. If your goal is time freedom and location independence, a luxury watch doesn't align with that. When you feel the urge to buy, ask, does this purchase move me closer to my freedom figure or further away? Reframe luxury as time and choice, not possessions. The power of financial affirmations, rewiring the system. Your relationship with money is dictated by the stories you tell yourself. If you constantly think, I'm bad with money, or rich people are greedy, your subconscious will actively repel wealth. We need to install the abundance operating system every morning during your clarity hour. Spend 1 minute reciting and truly believing these core truths. I am an architect of wealth, and I control my money. Rejects the victim narrative. My investments are growing and compounding rapidly. Focuses on the engine, not the struggle. I create massive value and I am compensated fairly for it. Affirms your skill and leverage. This isn't magic, it's mental conditioning. You wouldn't let a negative voice dictate your career, so don't let it dictate your finances. Your action step for this episode is to identify your single biggest psychological trap. Is it lifestyle creep or comparison? And implement the corresponding fix immediately. The outer game is won by tactics. The inner game is won by mindset. Master both, and true freedom is inevitable. You've built the empire! You've mastered the inner game. But a great fortress is only great if it can withstand siege. The modern financial world is under constant attack from 3 primary enemies: inflation, taxes, and legal risk. This episode is about defense. It's about ensuring your investment engine doesn't just grow, but that its real value is protected. Defense 1. The inflation shield, the silent thief. Inflation is the silent thief, stealthily eroding the purchasing power of your money every single year. Holding large amounts of cash is a losing strategy because the cash becomes less valuable tomorrow. The fix. Growth, assets, and tips. Growth assets. Your primary defense is maintaining a strategic allocation in assets that historically outpace inflation. This means equity investments. Pillar 1. Index funds and income-producing real estate PRD, which tend to increase in value and rent over time as the cost of living rises. Inflation-protected securities. Tips. For the portion of your portfolio that needs maximum safety like part of your financial firewall, consider Treasury. Inflation-protected securities tips. These are government bonds where the principal value adjusts with the consumer price index CPI, directly protecting your capital from inflation. Defense 2. Tax optimization, the legal edge. Taxes are your largest single annual expense. The difference between a smart investor and an amateur often boils down to how they legally manage their tax liability. The goal is not to avoid taxes, but to defer and minimize them. The fix. Priority accounts. Tax-advantaged accounts. Prioritize maxing out every available retirement and tax-sheltered account first. For example, 401,000 IRA, SA. Money grows tax-deferred or tax-free. This isn't just about retirement. It's about making your compound returns larger because the government isn't taking a slice every year. Location and asset placement. Understand the difference between ordinary income tax, your salary, and capital gains tax profits from investments. If you have to hold assets in a taxable brokerage account, prioritize assets that produce long-term capital gains like index funds you rarely sell, over assets that produce high income like bonds or REITs, which often yield income taxed at a higher rate. Defense 3. Legacy protection, the fortress walls. You've dedicated years to building your wealth? The final stage is ensuring that wealth is transferred efficiently and securely, minimizing legal challenges and unnecessary taxes. The fix. The 3 key documents. Will, this document dictates how your assets are distributed upon your death. Without it, the government decides. This is non-negotiable. Trusts. For serious wealth, a trust can provide far more control than a simple will. It protects assets from being tied up in probate, can offer a creditor protection, and helps structure how wealth is distributed to heirs over time, not just in one lump sum. Insurance. This is your shield against the unexpected. Adequate liability coverage umbrella insurance protects your net worth from lawsuits, while life insurance protects your family's financial stability against the loss of your income. The example. Ultra-wealthy families spend more on lawyers and accountants than many people earn in a year. This isn't wasted money. It's an investment in permanent preservation. Their primary job shifts from creating money to protecting it from the outside world. Your action step for this episode is to schedule a consultation with a tax professional or financial planner to ensure you are maximizing your tax-advantaged accounts and have the basic 3 key documents in place. You've built the fortress. You've protected it from inflation and taxes. But even the strongest fortress can become obsolete if it doesn't adapt to the changing landscape. The world of wealth is moving faster than ever, driven by technology and innovation. This episode is about installing the final piece of software, the exponential mindset that believes that your potential is not fixed, and that continuous learning is the most profitable investment you can make. The law of perpetual education, your highest AROI asset. Your education didn't end with school. For the wealth architect, it's a daily, mandatory discipline. The moment you stop learning, your wealth trajectory flattens. The ritual, the 5-hour rule. Dedicate 5 hours per week, 1 hour per weekday to deliberate, practice, or learning relevant to your leveraged play or your investment engine. This isn't passive scrolling. This is focused, deep work on skill mastery. Studying new techniques in your 1% upgrade skill, for example, advanced AI prompt engineering, complex financial modeling, market intelligence, deep diving into the sectors your investments occupy, for example, reading quarterly reports, understanding regulatory shifts, mentorship, seeking out and learning from people who are already where you want to be. The example, Bill Gates and Warren Buffett both dedicate significant portions of their days to reading. They understand that their edge comes from superior knowledge and foresight. They are fundamentally professional learners. Expanding the revenue horizon, the second mountain, the exponential mindset, rejects the idea of a single income peak. It constantly asks, how do I apply my mastered skills to a new, larger opportunity? Your first leveraged asset got you off the ground. Now, you use the cash flow from that asset to fund your second mountain, new, potentially larger revenue stream. If your first asset was a profitable online course teaching marketing, your second mountain might be investing that profit into a specialized, high-margin SaaS software as a service product that automates part of that marketing process. If your first asset was successful stock investing, your second mountain might be syndicating small real estate deals for others, leveraging your acquired capital and expertise. The key is reinvestment of cognitive capital. You use the knowledge you gained on the first project to reduce the risk and accelerate the success of the second. The visualization of expansion, breaking the ceiling. Psychologically, your net worth often stalls at the highest number you can truly visualize and believe you deserve. If you've never seriously considered being a multimillionaire, your subconscious will create obstacles when you approach that boundary. The fix, the visualization leap. Regularly visualize the next 2 financial milestones beyond your current North Star. If your North Star is $2.5 million. Start visualizing what the portfolio looks like at $5 million and what kind of impact you will be making. This process mentally expands your financial ceiling, allowing you to recognize and seize opportunities you would have previously filtered out. You've optimized your mindset, your income, and your investments. But what if I told you the greatest lever you have for building wealth isn't your capital? It's your time and your energy. The truly wealthy don't just work hard. They work on the right things at the right times. Today, we're diving deep into how to apply the 80-20th rule. The Pareto principle to your daily life, ensuring that just 20% of your effort generates 80% of your financial results. Let's get into it. Think about your financial energy. Where does it go? Most people spend 80% of it on low-impact tasks, clipping coupons, tracking every single tiny expense, or driving across town to save a few dollars. These activities feel productive, but they yield minimal returns for the time invested. Instead, we need to adopt what I call the architect's focus. This means concentrating your energy on the high-impact 20%. What are these? First, income generation, working on your unique leveraged asset. That one activity that generates the most nonlinear income for you. Second, investment decisions, the focused time you spend researching and executing your long-term portfolio strategy, like rebalancing. And third, skill acquisition, that dedicated time for learning, following the 5-hour rule we've discussed before. So how do you make sure this actually happens? You need a ritual, and that ritual is time blocking for wealth. I want you to go into your calendar right now and physically block out time for your high-impact 20%. These aren't suggestions. They are non-negotiable meetings with the CEO of your financial future, and that CEO is you. If a task isn't scheduled, if it's not blocked out, it simply won't get done in our busy world. This simple act of calendaring your priorities is the first step to taking control. Now, you can have all the time in the world blocked out, but it's useless if you're mentally and physically depleted. You can't do high-impact work if your battery is always on low. Energy is the true currency of high performance. Honestly, the difference between a 6-figure earner and a 7-figure earner often comes down to the quality of their output, not just the quantity of hours they put in. The fix for this is what I call the ultra-focus protocol. You need to structure your day around intense 90 to 120-minute blocks of deep work, completely free from distraction. The key here is to identify your peak energy window. Are you a morning person or a night owl? Whatever it is, you must reserve that sacred window exclusively for your most important work, your leveraged asset. Between these deep work sessions, you must force yourself to take a 10 to 15-minute break where you fully disconnect, get up, move around, hydrate, stretch. This is how you recharge your cognitive battery for the next round. As Cal Newport, who popularized deep work, argues, in our hyper-distracted world, the ability to focus without interruption is the single most valuable skill you can possess. Finally, let's talk about the delegation decision. As your income grows, you have to stop trading your valuable time for low-value tasks, even if you're good at them. It's a mindset shift. Your hourly rate for high-impact work is now significantly higher than the cost of delegating simple tasks. Always ask yourself this one question. Can this task be outsourced for less than my peak hourly rate? This applies to both your finances and your life. Remember in episode 7 when we talked about hiring a bookkeeper or tax accountant? That's financial delegation. But what about life delegation? Outsourcing chores, grocery delivery, or administrative tasks. Every time you delegate a $20 per hour task, you're not just saving time. You are buying back an hour to work on your leveraged asset, which could be worth $200 or even $2,000 to you. You are literally buying time to invest in your wealth. So here's your action step for this week. I want you to audit your last 2 weeks. Identify the top 3 time-wasting, low-impact activities that are draining your energy and giving you almost nothing in return. Once you've identified them, you have 2 choices: block them out of your life completely or delegate them immediately. Master your time and energy, and you will master your destiny. Thank you so much for watching. If this brought you any value, please hit that like button and subscribe for more content on building real, sustainable wealth. I'll see you in the next one. You've built a robust, diversified financial base, but to achieve truly exponential growth, to leap from millionaire status to multi-status, you must adopt the mindset of a venture capitalist VC. VCs don't succeed by betting on every company. They succeed because 1 or 2 massive wins generate returns that dwarf all their other failures combined. We're going to apply this power law thinking to your personal and professional portfolio. The 90-10th rule for allocation your core portfolio, built on index funds and real estate pillars 1 and 2, provides stability and guaranteed compounding. This is your foundation, the 90% safety net. The VC mindset applies to the remaining 10% of your investable capital. This is your moonshot fund. Money allocated to High reward opportunities that have the potential for a 10x to 100x return. The strategy: accept loss. Assume you will lose 50% to 70% of the capital you allocate here. This is the cost of admission for high return potential. Bets on asymmetry. Focus on investments with highly asymmetric risk profiles. Limited downside. You only lose 10% of your total portfolio, but unlimited upside, a massive technological or market shift. Example assets. Early stage startups. Niche specialized leveraged assets like a new SaaS product in an unproven market or emerging volatile asset classes. The talent bet, the best VC investment, the most profitable investment a venture capitalist makes is often in people. You need to apply this to yourself and your inner circle. Your personal VC investment. Treat your time and money as capital. You are investing in talent. Investing in your network. Spend time cultivating relationships with other high-performing, ambitious architects. They bring new ideas, opportunities, and accountability, acting as a free, high IQ board of directors for your life. Investing in yourself hyper-specialization. If your rule identifies a nascent skill that could become massive, for example, advanced machine learning in your specific industry. Pour resources into becoming the global 1% expert in that micro niche. The return on investment for hyperspecialization is often the highest in the modern economy. The example of Peter Thiel. Thiel, a co-founder of PayPal and legendary VC, didn't just invest in Facebook. He invested in Mark Zuckerberg. He was betting on the founder's tenacity and vision. Your job is to constantly bet on your own tenacity and vision and surround yourself with others doing the same. The risking, the big wins, the exit strategy. The ultimate test of the VC mindset is not making the big win, but keeping it. If one of your leveraged assets or a moonshot investment skyrockets, you must have an exit strategy. The ritual. De-risking. As a high-growth asset doubles or triples. Systematically sell small percentages and immediately sweep the profits back into your stable 90% safety net. Your index funds and real estate. This locks in the gains and protects your net worth from catastrophic market swings. Don't let a huge paper gain evaporate because of greed or inaction. Your action step is to define your 10% moonshot budget and identify one high asymmetry investment time, skill, or capital you will make this quarter. You've built a system designed for growth, but systems fail when they become rigid. Economic cycles are inevitable. Booms, recessions, technological disruptions. The true mark of a master architect is not how high they build in a calm market, but how well they withstand the inevitable storms. This episode is dedicated to agility, the ability to adapt, pivot, and profit from volatility. The 3 phases of economic change instead of reacting emotionally to the news. The wealth architect identifies and prepares for 3 predictable phases. 1. The boom phase preparation. When the market is euphoric and money feels cheap, this is not the time to take maximum risk. This is the time to build your firewall. Episode 7. Increase your cash reserves and actively de-risk your largest positions. The de-risking ritual from episode 10. Preparation is the ultimate form of profit-taking. 2. The contraction. Recession phase acquisition. When fear peaks and asset prices drop, this is the time to deploy capital. Recessions are simply sales periods for high-quality assets. You need cash, clarity, and courage. Your financial firewall protects you, allowing you to buy assets at a discount while others are forced to sell. 3. The recovery phase acceleration. As the market bottoms and starts its slow ascent, the time for patience is over. This is the moment to fully commit capital, knowing that the fastest returns often happen at the start of a new cycle. The stress test ritual. You can't wait for a crisis to test your plan. The wealth architect proactively identifies weaknesses in their financial structure. The ritual. Once a year, perform a financial stress test. Scenario 1. Income shock. What happens if your main income stream, salary or leveraged asset, suddenly drops by 50% for 6 months? Does your firewall cover it? Do you have a backup revenue skill, your 1% upgrade skill you could immediately monetize? Scenario 2. Asset crash. What happens if your total investment portfolio drops by 30% overnight? Does this force you to sell to cover bills? If the answer is yes, your portfolio is too risky and your firewall is too small. The goal of the stress test is not to scare you, but to give you specific actions to take now to increase flexibility. Career agility, the T-shaped skill set. Your personal career is one of your most valuable assets, and it must be agile. Adopt the T-shaped skill set model. The vertical bar, deep expertise. Your single 1% upgrade skill, for example, advanced data analysis where you are undeniably world-class. This gives you high leverage and premium pricing. The horizontal bar, broad competence. Broad knowledge in complementary areas like finance, marketing, technology, and leadership. This allows you to communicate across departments, see opportunities others miss, and pivot your deep expertise into adjacent, higher growth fields. The example: Jeff Bezos always preached day one mentality, the constant need to operate with the agility and hunger of a startup, even when Amazon became a giant. This fear of rigidity is what drives constant innovation and adaptation. Your action step is to define one potential pivot point for your primary income stream. If your current market vanished tomorrow, what T-shaped skill would you immediately monetize, and who would be your first customer? We have covered the systems, the strategies, and the schedules. But the moment you face real market volatility, all the logic in the world can dissolve into a single, terrifying instinct: panic. The greatest threat to your financial fortress is not inflation or taxation. It is the amateur psychology that takes over when your portfolio is down 20%. This episode is about mastering the two emotional killers: fear, leading to panic selling, and greed, leading to FOMO and reckless buying. The killer one: fear, panic selling. Fear forces you to make permanent decisions based on temporary data. When the market is crashing, the amateur investor feels intense pain and sells at the bottom, locking in the loss. The fix: the 0-day rule. If the market drops 5% or more in a single day, you are forbidden from touching your portfolio for 24 hours. You cannot log in, check prices, or read news headlines. This simple rule creates a necessary cooling-off period. It forces a delay between the emotional stimulus fear and the action selling. You will realize that the world did not end, and you preserved your capital for the eventual recovery. The example of John Bogle, the founder of Vanguard, famously advocated for simplicity and patience. His strategy was essentially a psychological defense mechanism. Set up your plan index funds and then do nothing. Inertia, in this case, is a huge financial advantage. The killer two: greed FOMO. Buying greed manifests as FOMO, fear of missing out. This happens when you see a specific stock or asset like crypto or a tech IPO rapidly soaring, and the primal urge to jump in overwhelms your rational strategy. This often leads to buying at the peak. The fix: the pre-mortem ritual. Before you invest in any hot asset outside of your established blueprint in 10% moonshot fund, conduct. No. Imagine it's 1 year later, and the investment has failed miserably. What specific, fundamental factor caused the failure? Did you lack domain knowledge? Was the valuation absurdly high? Did you invest money you needed for your firewall? This ritual flips the psychological script. Instead of focusing on the irrational high of potential gain, it grounds you in the rational risk of actual loss. If you cannot define a specific failure point, you probably haven't done enough due diligence. The final decision rule: the commitment device. The best way to eliminate bad decisions driven by emotion is to make the decisions ahead of time when you are calm and rational. This is your commitment device. The rule: you will only buy when assets are cheap, when the market is fearful, and you will only sell when assets are expensive, when the market is greedy. Buy signal: when major indices drop 10% or more, automatically deploy a small, pre-allocated portion of your cash reserve. Buy when there is blood in the streets. Sell signal: when a single non-core asset in your moonshot fund has exceeded your predetermined gain target, for example, 50%, you sell half and sweep the profit into your stable. 90% safety net, the die-risky ritual. You must view the market not as a reflection of reality, but as a reflection of mass human psychology. When everyone is fearful, be greedy. When everyone is greedy, be fearful. Your action step is to define the exact percentage you will deploy if the market drops 10% tomorrow. Write it down and commit to it. This takes the emotion out of the crisis. You've built the machine! You've conquered the emotional demons of fear and greed. But how do you know if you're winning? Most people look at the wrong numbers. They focus on vanity metrics, the big, impressive, but ultimately meaningless figures. Your gross annual salary, a vanity metric. Your total portfolio value, also a vanity metric. If you ignore your debt, these numbers feel good, but they don't tell you the most critical thing: How close are you to being truly free? The Wealth Architect needs a scorecard built on ratios that measure true financial health and speed. We focus on 3 crucial metrics. Metric 1, the freedom ratio. This is the only number that truly matters. It measures your proximity to your North Star, your ultimate destination. Formula.net worth annual expenses. If your annual expenses are $100,000 and your net worth is $500,000, your freedom ratio is 5. This means your current assets can fund your lifestyle for 5 years if you stopped working today. Remember the goal from episode 1? Your ultimate North Star is a freedom ratio of 25 or higher, depending on your safe withdrawal rate. Your weekly ritual is to track the increase in this ratio, not just the dollar value of your investments. Are you making lifestyle sacrifices to increase the numerator net worth, or decreasing expenses to reduce the denominator annual expenses? This ratio forces you to focus on leverage and efficiency. Metric 2, the velocity ratio, the speed of compounding. Your investment engine is running, but how fast is it accelerating? This ratio tells you if your money is generating returns faster than you are feeding it new capital. Formula: investment gains, new contributions. Let's say last year you contributed $20,000 of new savings to your portfolio. If your velocity ratio is less than 1.0, it means you are primarily building wealth through brute force saving, and your investment engine isn't optimized yet. The strategy: when this ratio raises above 1.5, you know your engine is self-sustaining. This is the moment you shift your focus almost entirely to the leveraged play income growth, trusting the engine to handle the heavy lifting of accumulation. Metric 3, the efficiency of leverage. The risk indicator debt isn't inherently bad. It's a tool. But poor debt management can sink the fortress. This ratio measures the safety of your borrowed capital against the assets it's built upon. Formula: total debt, total assets. If this ratio is 0.550%, it means half your assets are owned by lenders. This is you unnecessarily bad. If that debt is good debt, low interest loans tied to appreciating assets like investment real estate. The critical threshold. The Wealth Architect keeps this ratio below a personal safety limit, often between 0.3 and 0.5. The lower it is, the more resilient you are to market crashes. If your asset value drops 30% in a recession, a high debt ratio could lead to forced sales. A low ratio allows you to hold by the dip and survive. Your final action step is to create your true wealth scorecard. Calculate these 3 ratios today. This is not about judgment. It is about precision. You can't navigate to your North Star if you don't know your current coordinate. In the next and final act, the legacy of freedom, we will synthesize all 12 episodes and discuss the philosophy of staying wealthy and truly maximizing the purpose of your hard-won freedom.